This is Greg from DLA Markets. Welcome to the channel. And on this live stream, I'm going to do a Fed update. I haven't done a market or Fed update in a while, so I thought I'd go live and take care of it. Today, as you probably know, was an important day because Jerome Powell gave a speech today at the Brookings Institute, and there was a question and answer period, and the market was greatly anticipating this speech and hoping that it would give them more insight into what the Fed is actually planning. Will they taper? Will they not taper? Will they lessen their interest rate increases? Will they keep it the same? And everyone was anxiously awaiting his response and what he had to say. And of course, the market today rallied tremendously. But we'll be talking about that and some of the other aspects that have happened in the last couple of weeks that will be affecting the markets, and that I think you will find interesting and hopefully pertinent to what you're doing in the stock or the bond markets or in your other various investments. Okay, so for you, if you're new to the channel, for those of you who are new to the channel, we talk about investments, we talk about the markets, we talk about Fed policy, interest rate trends, macroeconomics, and we also go into specific stock recommendations on this channel. So I'd like to welcome you if this is the first time you're either seeing the live event here or you're watching it on the replay. Okay, so Jerome Powell came out today and he gave his speech, and I'm just going to go through, just summarize basically what he said and what I think the implications are, okay? So inflation is still high, right? The last print on GDP, on inflation, overall inflation was 7.7%, which was down slightly from over 8%. And that gave the market some hope, or certain participants in the market anyway, some hope that inflation was moderating and that it would lead to the Fed perhaps slowing the rate at which they're increasing interest rates. Okay, so he basically said that interest rates are still high and persistent. He said, in general, we basically have a long way to go before inflation is tamed down to the 2% target. We're currently at 7.7%. Of course, that's a government number. As we often say on this channel, that's kind of a make-pretend number, because we believe the true rate is certainly over 10% and probably as high as 15%. But that's the official government number that we have to play with, but that's a long way from 2%. He talked about housing, okay? So housing cost is a big component of inflation. Housing is still very tight. Apartment rents are still high and going up. In some areas of the country, they're moderating somewhat, but in general, housing prices are still continuing to climb rather rapidly. So that's a negative. Labor, he focused on labor. Labor is still incredibly tight. Okay, he talked about how a lot of people, a lot of older people during the pandemic and stuff like that, they basically retired. They're not coming back to the labor force. There's not enough people coming into the labor force that are younger to take a lot of these jobs. There's still a tremendous difference between the amount of jobs that are available and the number of people available to take those jobs. Something like 7 to 10 million job difference between the amount of people that are around to take the jobs and the amount of people that or the amount of jobs that are available. So there's still this incredible tightness in the labor market. He also talked about the labor participation. Labor participation is around 62%, which is historically pretty low. There are people still, for whatever reason, not working that are able-bodied and could work. They're still not working. We don't know really why that is. He talked about the pandemic. I can't believe people are still talking about that, but he talked about the pandemic, and you know, I believe that there are still people out there that are getting some form of government assistance, and so they don't have to work. I don't know who these people are, but apparently they're out there. So the labor market is still tight. The housing market is still tight. These are two huge negatives. And I think the biggest one is wage growth. Okay. He was saying that wage growth is not moderating. Wages are still growing at a very rapid rate, which is, you know, on an individual basis, I guess is good. Of course, inflation eats into a lot of that, right? But on an individual basis, it might be good. From the standpoint of inflation, it's terrible because labor is a very large component of inflation and rising costs. That cost of that labor is a big input into rising inflation, and he's saying that that is still extremely tight. And he also emphasized at several points in his presentation this this aspect that they are totally committed to getting inflation down to the 2% target. Okay, and given the fact that we are so far away from that, it leads me to conclude that we still have a very long period of time to go to rein in this inflation. So that leads me, and I thought it would lead more people in the market, to believe that rates are going to continue to go up, albeit potentially at a slower rate. This is going to take a very long time to solve this problem, in my opinion. The thing that the market got so giddy about today, and I'm sure you're all aware of it, but the Dow was up like 737 points. The NASDAQ like rocketed up. It was up 484 points. That's 4.4%. That's a very big rise for one day in the NASDAQ. Of course, the tech stocks were kind of oversold, so that was part of it. Of course, the S&P was up about 3%. So the market was giddy. The market got bullish all of a sudden, but I think that was mainly because he indicated that the next rate increase was going to be 50 basis points as opposed to 75 basis points. So, you know, I think it was overblown, but as I've tried to communicate many times on this channel, I think daily rises and falls in the marketplace on a daily basis, they literally mean nothing. It's an emotional reaction. Tomorrow it could go down 700 points if something else happens. So it really means nothing. I think we're still in a bear market because he basically has indicated that the monetary policy is going to remain tight for a very long time. Okay, and we've talked extensively about why this is and why I think that this situation is quite different from past time periods. The government under Joe Biden has flushed into the system trillions and trillions and trillions of dollars over the last 2 years, and it started with Trump. With the COVID relief packages and all this kind of stuff. And so there's $3 to $5 trillion that was allocated. It's all borrowed money. It's all money we don't have. And that money, a lot of that money, the money from the infrastructure bill, for example, and the Inflation Reduction Act, which the name of that, of course, is a joke because it was, for lack of a better word, transfer payments to Green New Deal companies. But that issue, putting that issue aside for a second, the point I'm trying to make is that a lot of this money is still not spent. So what you're seeing is you're seeing on the fiscal side, which is the government spending side, you're seeing a lot of that money trickling in or being forced into the system, raising demand. And meanwhile, the Fed is sitting there raising interest rates and draining liquidity from the system, trying to decrease demand. So you have these two opposing forces, the government money being spent and the Fed trying to bring things down. And because of this, I think the inflation is going to remain very, very persistent, and it's going to be that much more difficult for the Fed using the levers that they have to slow the economy down to the point where demand gets back in line so we can get down to the 2%. It's going to be extremely difficult, okay? I think the one good thing in that respect is the fact that the Republicans did take control of the House. That will put, at least for the time being, kind of a break on any more potential spending from the government. So that's going to be slowing down. But a lot of that money hasn't been spent. So you really have that pressure continuing to go into the system and increase demand, fighting what the Fed's trying to do. Okay, so we have a long way to go, and anyone who thinks that the Fed is going to stop raising interest rates and start lowering rates is completely delusional. That's not going to happen. We're going to be in a situation of tight monetary policy for the foreseeable future, which is why I think we're still in a bull market. If you're concerned about your portfolio, I'd be using every rally to sell your losers, raise cash, and prepare for further downturns in the market, which I think inevitably will come. Another reason for that, I think, is that as time goes on, and you're seeing it with all the job cuts and everything, you're going to see a further deterioration in corporate earnings. I think that's going to continue, and that's another risk for the market. Okay, talking about other risks. I've mentioned this before in other videos, but I think it bears repeating. Jamie Dimon made this point a month or so ago, and I think it's still front and center in my mind in terms of risk to the market. I think the geopolitical risks that we have now are far greater to the market than rising interest rates, because I think in many ways the rising interest rates are already factored in to stock prices. I think the unknowns in Ukraine, in China, are a greater risk to the market now because nobody's talking about it. Nobody's thinking about it, okay? Just think about this for a minute. Think about if Putin wakes up one day and he decides he's losing the war, he can't lose the war, the United States keeps funding it, it's a proxy war against him, he's got to do something to really shake things up, and he either uses a tactical nuclear weapon or a dirty bomb or something. Just think about not only what that would do to the market, but I mean, oil prices would like overnight go to 150 to 200. I mean, like overnight. And think about what that would do to the market. That would be absolutely devastating, not only to the market, but to the world economy. So that's something it's looming out there. I wouldn't put it past them. I think it's a very real risk, in addition to just this grinding Ukrainian situation that just keeps grinding and grinding, and the United States gets more and more involved as time goes on, and nobody can really say where it's heading. Okay, the other risk is China, of course. Now, one of the things I find quite amusing is anytime Iran or China, anytime there's protests or uprising or people get violent or whatever, the U.S. media latches onto it, and this is where the people are going to overthrow China, and they're not going to be communist anymore, and all this kind of just complete nonsense. Nothing's going to happen in China. The people aren't going to make any impact. the most that's going to happen in China is eventually they're going to realize how idiotic this zero COVID lockdown is, and how much it's hurting their economy. And eventually they'll open up again. And once they open up again, my whole thesis with the oil market and inflation in the world economy is going to be in place, because once their demand for oil increases, the entire world is going to feel it. And I see oil prices going above 100 again and probably staying there. Okay, that's my opinion about that. But these governments, these dictatorial governments, these communist governments, they will use any level of force to maintain order. And basically, I don't believe the people have a chance of overthrowing the government. Or Xi's not going anywhere. The premier, or whatever you call it, of China, he's not going anywhere. Okay, he is firmly in power. Nothing's going to change there. Okay, I think the one thing that I found interesting was Apple, we heard, was actively looking for alternatives to their manufacturing facilities in China. I think that is the tip of the iceberg. I think a lot of companies, American companies, are going to be rethinking their strategy on manufacturing goods in China. I see this as very bearish for China. I wouldn't want to live in China right now. I think China is on its way down economically, and I think that is a process that's going to continue as the world realizes that they are not a partner that meets the criteria of the modern day world in terms of ethics, or in terms of governance, etc. Okay. Now, I guess probably the last thing I wanted to talk about is just some of the stock recommendations I've made on the channel. If there are any changes there. Exxon and oil and gas, Chevron, which I've recommended for a long time on the channel. I'm still solidly in those names. I think that the structural supply-demand imbalance in the oil and gas market is still in place. And I think some of the discoveries that Exxon has made, in particular, Guyana, for example, are showing enormous returns. In some cases, some of those projects in Guyana are showing 2-year payback periods, which is unheard of in the oil and gas industry. They have break-evens as low as 30. And they're up to 11 billion barrels of discovered oil resource there, and that's going up. They're discovering more virtually every month, and that is highly profitable for Exxon. And I think Exxon is enormously well positioned in the world to benefit from, again, the structural oil and gas imbalance, and also the oil and gas embargo that Europe is implementing against Russia is just now kicking in. It's kicking in December 1st. It'll take a while to kick in, but that, combined with what they're trying to do, limiting the price of oil to Russia, I think all of that is going to play into the constructive view that I have on oil and gas going forward, and Exxon and Chevron in particular. Okay. So I'll be coming out with more content, more videos on these and other issues. I'll probably do another one on the Guyana discovery. That video has been very popular, both the original ones that I did 2, and then I did another one about how much Guyana will make, and I had the contract out, and I'll actually put this at the end of this video, like up here, so you can take a look at that one. The amount of money that both sides, the Exxon consortium and Guyana, are going to make is just absolutely obscene. So that's arguably one of the greatest oil discoveries in history. So I'll be doing more content on that, and more content related to the market, and all issues and subjects that I think will benefit you as an investor to make you a better and hopefully richer investor. Okay? Well, thanks for joining the live stream. We'll have more content coming out later in the week, and I appreciate you joining here. Check out this video and this video at the end, and we'll see you on the next either live stream or video. Thanks for joining, and I'll see you on the next one.